Price moves all week, but the move keeps meeting memory. The week forms inside stacked pressure. This week is not just a recap. We go back into the chart. We move through the week like live execution. One session at a time. One decision at a time. Entry. Stop. Target. Trail. Or no trade. That is where the account survives. A trader does not need every candle. A trader needs the right line. This week gives that line many times. A long starts before the breakout. A short starts after recovery fails. A final session holds the midpoint. But time removes the trade. That contrast matters. Because price can move. But movement alone is not enough. Price must reach the level. It must react. It must hold. Or it must fail. Only then does the trade appear. We start with the 1-hour chart. Monday to Friday. Asia session. US session. Session box. Upper boundary. Midpoint. Lower boundary. Extension. Stop line. Target line. Risk reward. Every part of the week came from the same question. Can price stay there? If price breaks above and stays, the long survives. If price breaks above and returns, the long fails. If price drops below and cannot stay, the short weakens. If price fails to reclaim, the short survives. This is the rhythm. Location. Reach. Reaction. Failure. Return. Then execution. The week did not move in a straight line. It pushed higher. It stalled. It dropped. It recovered. It compressed. It tested larger memory. That is why a trader cannot trade direction alone. Direction looks easy after the candle moves. But entry is already late there. The real entry usually forms earlier. At the boundary. At the failed reclaim. At the lower memory hold. At the moment when price cannot stay where it tried to go. This week showed that again. A breakout looked strong. But the long had to begin lower. A bearish candle looked clean. But the short still needed proof. A midpoint held. But the final session had no time left. So the method stayed strict. No chase. No emotional entry. No trade without a stop. No stop without structure. No target without memory. No trailing without earned distance. First, the 1-hour chart gives the action. It shows where price moved. It shows where entries formed. It shows where stops belonged. It shows where targets were realistic. But the 1-hour chart does not explain the whole pressure. For that, we need the higher time frames. Daily chart. Weekly chart. Monthly chart. They show why the 1-hour chart kept acting the way it did. Why some longs paid fast. Why late longs became dangerous. Why shorts needed failed recovery first. Why final session trades needed restraint. Why the same price zone kept pulling price back. The daily chart gives space. The weekly chart gives pressure. The monthly chart gives the larger memory. The 1-hour chart gives execution. You need all of them. Because next week does not begin from zero. It begins from what this week left behind. If price opens near higher timeframe resistance, chasing is dangerous. If price pulls back into lower memory and holds, the next long can form. If price reaches upper memory and fails, the next short can form. If price compresses inside the same zone, no trade can protect the account. That is the plan. Not prediction. Preparation. We will first move through the 5 1-hour trading sections. Those sections show the live decisions. Where to enter. Where to stop. Where to target. When to trail. When to avoid. Then we step back. Daily. Weekly. Monthly. The larger charts show the reason behind the week. They show why the rally had limits. They show why the breakout still needs proof. They show why next week must respect the 0.5 zone, the 120 moving average, and the 2026 monthly lower boundary. The chart keeps asking the same question. Can price stay there? If it can stay, the trade survives. If it cannot stay, it returns. If distance becomes shorter, the move weakens. If reaction comes faster, continuation fails earlier. If the session forms inside old memory, the trade needs more proof. That is the weekly structure. Price reaches. It reacts. It holds or fails. Then you execute. Price pushes up. But the trade cannot stay simple. The session forms inside extended memory. May 3rd Asia session forms between May 1st U.S. session midpoint and May 1st U.S. session 150% area. It does not form in open space. It forms inside extension. It overlaps old pressure. It starts above recent memory. That matters. When a session forms between a midpoint and an extension area, price is already under pressure. It can continue higher. It can also snap back fast. So the first rule stays the same. Do not chase the first push. Wait for the boundary. Wait for holding. Wait for price to show where it cannot stay. May 3rd Asia session first moves lower. It reaches May 1st U.S. session midpoint. It tests. It reacts. It cannot stay weak. That test matters. If sellers had control, price should hold below that midpoint. It should create distance. It should keep pulling down. But it does not. The reaction comes back. The drop loses pressure. The lower test becomes the first warning. Then price turns up. It breaks above May 1st U.S. session upper boundary. Now the move is stronger, but it still needs proof. Price must stay above the broken boundary. It must not return immediately. It must build distance. It pushes again. It breaks above May 3rd Asia session upper boundary. Now the session is no longer trapped inside the box. The move starts to extend. But extension creates a new problem. Every higher target becomes more sensitive. Every pullback matters more. Every reaction can end the move. Price continues upward. It reaches May 3rd Asia session 200% area. That area is important. It sits near the weekly 0.5 area. So the move is not only reaching a session extension, it is reaching larger time frame pressure. That changes everything. A trader cannot treat that area as ordinary continuation. Price reaches the 200% area. It touches. It reacts. It has to prove holding. If it stays above, continuation can continue. If it cannot stay, the long may be finished. Now go back to the first long. The long setup starts earlier. Long entry line. April 30th Asia session lower boundary. Stop loss line. April 27th U.S. session midpoint. Take profit line. May 3rd Asia session upper boundary. The entry is not at the top. The entry is not after the breakout. The entry comes from lower memory. April 30th Asia lower boundary becomes the long entry line, because price had to hold lower structure first. If price could not hold there, there was no long. If price held there and moved away, the long could build. That is the difference. A late buyer sees the breakout. A structured trader waits for the lower boundary to hold first. The stop sits at April 27th U.S. session midpoint. There is a closer option. Some traders may use April 27th U.S. session upper boundary. That gives a better looking risk-reward. It looks cleaner. It feels more efficient. But May 3rd Asia session shows hourly movement with enough pressure to make that stop risky. Price can dip. Price can test old upper memory. Price can touch the tighter stop. Then it can continue higher. The trade idea may still be alive, but the position is already gone. So the safer stop sits deeper. April 27th U.S. session midpoint. At minimum, the stop needs to sit below that area. Why? Because if price reaches April 27th U.S. session midpoint, the lower memory has weakened much more. The long no longer has clean control. That becomes real damage. Not noise. Not discomfort. Real failure. The first target sits at May 3rd Asia session upper boundary. That is the first place where the new session must prove itself. If price reaches the upper boundary and cannot hold above, the long has paid. If it holds and moves away, the trail can begin. Now price does move away. It breaks above the upper boundary. The trade earns distance. So trailing becomes possible. First trailing target. May 3rd Asia session 150% area. Price already left the original target. It has earned a larger objective. But the target cannot move alone. The stop must follow. If the stop stays too far behind, the trail becomes hope. If the stop moves too tight, normal reaction removes the trade. So the stop must follow structure, not emotion. Price moves again. Second trailing target. May 3rd Asia session 200% area. This area matters more. It is also near the weekly 0.5 area. Risk-reward ratio, 2.31. That is where the long must be treated carefully. The market has reached session extension. It has reached higher timeframe pressure. It has traveled far enough. You do not assume it will continue. You watch the reaction. Price reaches the 200% area. It does not create clean distance right away. Reaction starts to matter. The long has already paid. The second trail has done its job. Now the same level can become the next trade. After the second trailing take profit, the 200% area becomes a short entry candidate. Short entry line. May 3rd Asia session 200% area. Stop loss line. May 3rd Asia session 300% area. Take profit line. May 3rd Asia session upper boundary. First trailing target. May 3rd Asia session midpoint. Second trailing target. May 3rd Asia session lower boundary. Risk-reward ratio, 2.02. The short does not start because price is high. It starts because price reaches the 200% extension, near weekly 0.5, and cannot stay cleanly above it. That is the key. The long ends there because the move reached pressure. The short can start there because the same pressure blocks continuation. One level. Two decisions. First, it pays the long. Then it can trigger the short. But only if behavior changes. Price reaches. It fails to hold. It reacts back. Then the short becomes possible. The stop sits at May 3rd Asia session 300% area. If price reaches 300%, the 200% failure has failed. The market has expanded again. The short no longer has control. You leave there. The first target sits at May 3rd Asia session upper boundary. That is where the extension began. If extension fails, price often returns to its own box. That first return is enough. Then, if price keeps moving lower, the trail can press toward the midpoint, then toward the lower boundary. But again, target cannot move alone. The stop must follow. A short that trails too tight can get stopped by normal reaction. A short that trails without protecting profit does not really trail. It just hopes for more. So the same rule holds. Trail only after price earns distance. Move the stop with the target. Protect profit. Do not suffocate the trade. Now the full May 3rd structure is clear. Price tests. May 1st US midpoint. It cannot stay weak. It breaks. May 1st US upper boundary. It breaks. May 3rd Asia upper boundary. It reaches May 3rd Asia 200% area near weekly 0.5. The long completes there. The short can start there. Not because opinion changed, because behavior changed. Long works when lower memory holds. Short works when upper extension fails. Entry changes. Stop changes. Target changes. But the rule stays the same. Price reaches. It reacts. It holds or fails. Then you execute. Price compresses, but the candle warns. The next session forms inside repeated memory. May 4th US session forms between May 3rd Asia session midpoint and May 3rd Asia session lower boundary. It compresses by about 50%. It overlaps there. It also forms between May 1st US session upper boundary and May 1st US session midpoint. That is another 50% compression. So the session is not sitting in empty space. It is compressed between two memories. May 3rd Asia memory. May 1st US memory. That matters. Repeated compression deserves attention. When a new US session forms inside the prior Asia structure, and also inside the May 1st US box, the market is preparing a decision. But attention is not entry. The session still has to prove direction. Now look at the basis candle. May 4th US session basis candle is a Doji candle. That matters. A Doji at compressed memory shows hesitation. Price opens the fight. It cannot decide immediately. It tests. It returns. It leaves uncertainty behind. So the first reaction after the Doji becomes important. Price starts to lift. It breaks above May 4th US session upper boundary. That first break matters. But a break alone is not enough. Price must stay above. It must create distance. It must not fall back inside the Doji range. Then price continues. It breaks above May 3rd Asia session upper boundary. Now the long setup becomes active. Long entry line. May 3rd Asia session upper boundary. Stop loss line. May 4th US session lower boundary. Take profit line. May 3rd Asia session 200% area. The entry sits at May 3rd Asia session upper boundary. Why there? Because May 4th US session first forms compressed below that level. Then price breaks above its own upper boundary. Then it reaches the May 3rd Asia upper boundary. If price can reclaim that line, the move is no longer stuck inside lower compression. The upper boundary becomes the decision line. If price holds above it, buyers can continue. If price returns below it, the breakout loses control. That is where the long begins. Not inside the Doji, not inside the compressed middle. At the reclaimed upper boundary, now the stop. In principle, a wider stop can be considered. Looking at the earlier May 4th US hourly flow, a safer structural stop could sit at least near April 27th US session upper boundary. That gives more room. It avoids noise. It protects against a deeper retest. But the chart gives another clue. There is a large bullish candle before the continuation. That candle changes the risk. When a strong candle expands away From the compressed area, a full return to the tail area becomes harder. Not impossible, but harder. If price gives back the entire large candle and reaches back into the deep lower area, the breakout has already lost strong control. So in this case, May 4th U.S. session lower boundary can be enough as the stop line. It is still below the session structure. It still protects the trade. It is not placed inside the middle. It gives the trade room without making the risk too heavy. That is why the stop can sit at May 4th U.S. session lower boundary. The target sits at May 3rd Asia session 200% area. Why there? Because May 3rd already showed that the 200% area matters. It is near weekly 0.5. It already acted as a major pressure zone. If May 4th U.S. long moves upward, the first serious objective is not random. It is that 200% area. Price reaches it. It tests. The trade has paid. If price holds above it, the next trail can begin. First trailing target. May 3rd Asia session 250% area. Price must earn that trail. It must hold above the 200% area. It must not return fast. It must create new distance. Then the trail can move. Second trailing target. May 3rd Asia session 300% area. That is a larger extension. It cannot be assumed. It must be earned. If price starts to stall near 250%, you do not force 300%. If price moves away cleanly, the trade can press. But once again, the stop must move with the target. Do not repeat the mistake. A bigger target with the same old stop is only greed. The stop has to follow the latest structure. It must protect what the market already paid. But it cannot be too tight. If it sits too close under the current candle, a normal pullback ends the trade. If it stays too far below entry, the trail does not protect anything. So the trail must do one job: protect earned distance. If it does not do that, do not trail. Now watch the full May 4th sequence. May 4th U.S. session forms compressed between May 3rd Asia midpoint and lower boundary. It also overlaps between May 1st U.S. upper boundary and midpoint. The basis candle is a doji. The market hesitates. Then price breaks above May 4th U.S. upper boundary. It breaks above May 3rd Asia upper boundary. It breaks above May 3rd Asia 200% area. It tries to reach May 3rd Asia 250% area. The long comes from reclaiming upper memory, not from chasing the candle, not from guessing continuation. The entry is May 3rd Asia upper boundary. The stop is May 4th U.S. lower boundary. The first target is May 3rd Asia 200% area. The trail can reach 250%, then 300%, but only after price proves distance. Now connect the two setups. The earlier structure gave a long into May 3rd Asia 200%. Then the same 200% area became a short candidate when price could not stay above. The next structure gave another long after May 4th. U.S. compression broke upward. The market did not give one opinion. It gave decisions. Lower memory held. Long. Upper extension failed. Short. Compressed doji broke upward. Long again. That is real execution. The chart does not care whether you want to be bullish or bearish. It only shows where price can stay. If price holds above upper memory, longs can continue. If price fails at extension, shorts can form. If price compresses inside old memory, you wait for the edge. If the edge breaks and holds, the trade begins. Everything returns to the same rule. Price reaches. It reacts. It holds or fails. Then you act. The next trade does not begin because price moves. It begins when structure gives the line. Price pushes higher, but the clean trade starts lower. The session forms inside extended memory. One wrong chase can kill the account. May 4th Asia session forms between May 3rd Asia session 200% area and May 3rd Asia session 150% area. It does not form in open space. It forms inside extension. It compresses. It overlaps. Price is already high. That matters. When a session forms between 150% and 200% extension, the market is not calm. The move already traveled. The range is already lifted. The easy part may already be gone. So you do not chase the top. You wait for the lower boundary. You wait for sellers to fail. You wait for price to move away. May 4th Asia session first drops. It breaks below May 4th Asia session lower boundary. That looks weak. It looks like the extension is failing. But the drop does not keep control. It cannot stay below. It returns. That return matters. If sellers had control, price should stay under the lower boundary. It should create distance. It should push back toward old memory. But it does not. The reaction comes back. The downside fails early. You feel the turn. The short looks possible. Then it disappears. Now the long can form. Long entry line. May 4th Asia session lower boundary. Stop loss line. May 3rd Asia session upper boundary. Take profit line. May 3rd Asia session 250% area. This long does not start because price is rising. It starts because price breaks below May 4th Asia session lower boundary and cannot stay there. The lower boundary gets tested. It fails to break. Price returns above it. That is the entry logic. The long is not chasing strength. It is trading failed weakness. The stop sits at May 3rd Asia session upper boundary. Why there? Because May 4th Asia session is compressed inside the extension zone. If price falls below May 4th Asia lower boundary and continues through the May 3rd Asia upper boundary, the long has lost control. That is not normal noise anymore. That is structural damage. The trade is no longer the same. So the stop sits at May 3rd Asia upper boundary. Now there is another possible stop. Some traders may try to use May 4th US session upper boundary. That would be deeper. It may look safer. But here, it creates a problem. May 4th Asia session is already compressed. If the stop goes too deep, the risk becomes too heavy. The reward cannot carry the trade. The ratio becomes weak. The trade stops being worth the stress. Deep stops break the ratio. Risk eats reward. The answer is no trade. A stop is not only about safety. A stop also decides whether the trade deserves entry. If the stop must sit so far away that the target no longer pays, the position should not exist. No expected profit. No trade. No clean structure. No trade. Risk without enough reward is not discipline. It is just exposure. So the stop cannot be placed only because it feels safe. It must sit where the idea fails and still allow the trade to pay. Here, May 3rd Asia upper boundary gives that balance. It protects the long. It keeps the trade usable. It gives room without destroying reward. Price moves up. It breaks above May 4th Asia session upper boundary. Now the trade starts working. But the move still has to pass the old extension levels. It pushes higher. It reaches toward May 3rd Asia session 300% area. That area is also May 4th US session 400% area. But we do not use May 4th US session box as the main measuring structure here. We use May 3rd Asia session box. Why? Because May 4th US session box was compressed and overlapped inside May 3rd Asia session box. The larger controlling memory is still May 3rd Asia session. When a newer box compresses inside an older box, the older box can still control the extension map. So the target structure stays with May 3rd Asia session. Price reaches May 3rd Asia session 250% area. That is the first target. The trade pays there. The clean trade is already finished. What comes after this is different. Now price is no longer offering easy execution. It is offering pressure. If price stalls there, you respect it. If price holds and moves away, you can trail. Trailing target. May 3rd Asia session 300% area. Risk-reward ratio 2.34. The trail is not automatic. Price must earn it. It must hold above the first target. It must continue to create distance. It must not return quickly back inside. May 4th Asia memory. If price reaches 250% and immediately reacts down, the trade has done enough. If price holds above 250% and keeps pushing, then 300% becomes possible. Now the trail needs management. When the target moves, the stop must also move, but the stop cannot be too tight. If you move the stop directly under the current candle, normal reaction can remove you. Then the original trade may pay more than the trailed version. That is a common mistake. A trail is not a way to feel safe. A trail is a way to protect earned distance. The stop must follow structure, not fear, not excitement, not the green candle. If the stop can move with enough room and protect profit, the trail works. If the stop moves but still stays below the entry line, the trail does not protect enough. Then the better choice can be to take the profit or keep the original plan. Do not trail just because price moved. Trail only when the trade has earned protection. Partial profit can help here. If price reaches the first target and starts to stall, you protect more first. A conservative trader can take 60% first and leave 40% for the trail. If price holds above the first target and distance keeps growing, you can leave more for continuation. An aggressive trader can take 40% first and leave 60% for the trail. The difference is simple. The conservative plan protects realized profit earlier. The aggressive plan gives more weight to continuation. Both plans need the same rule. The remaining position must still have a stop that makes sense. If the second push slows, you do not wait for the perfect top. A conservative trader can take 50% first, then 30%, then 20%. If pullback stays shallow and reaction does not return fast, the aggressive plan can press harder. An aggressive trader can take 20% first, then 30%, then 50%. The aggressive version pays more, only if continuation really happens. If the move stalls, the conservative version survives better. So you choose based on behavior, not personality, not hope, behavior. Price reaches, it reacts, it holds or fails. Now look at the full May 4th Asia structure. The session forms between May 3rd Asia 150% and May 3rd Asia 200%. It drops below its lower boundary. It cannot stay below. It returns. The long starts at May 4th Asia lower boundary. The stop sits at May 3rd Asia upper boundary. The first target sits at May 3rd Asia 250%. The trail can extend to May 3rd Asia 300%. Risk-reward ratio 2.34. The trade works because lower failure appears first, not because the market is always bullish, not because the chart looks strong, because sellers fail to hold below lower memory. That is the signal. The next trade only begins when price gives another decision. Price moves higher, but the next session refuses clarity. The session forms near extreme memory. May 5th U.S. session forms near May 4th U.S. session 400% area. That same area also aligns near January 30th U.S. session minus 200% area. So the market is not sitting in ordinary space. It is sitting near a stretched extension level. That matters. When a U.S. session forms near a 400% extension area, the move has already traveled far. Price can continue. But continuation needs clean holding. Without holding, the upper area can become a trap. Now look at the candle. May 5th U.S. session basis candle has a long upper wick. It also has Doji behavior. The session opens with the basis candle. It reaches high. It cannot stay there. You see hesitation immediately. You see the rejection. You cannot chase. The candle reaches higher. It cannot stay. It leaves a wick. Buyers touch the upper side. They do not hold it. That does not automatically give a short, but it warns you. The upper test is not clean. The market is struggling to fix direction. Then, price rotates inside May 5th U.S. session box. It does not leave cleanly. It does not build distance. It does not give a simple entry. Price stalls inside. Bodies shrink. Wicks grow. The box keeps pulling price back. You feel the trap. You want the short. It does not break. You want the long. It does not hold. This is where many traders force action. They see the long upper wick. They want the short. They see price above the 120 moving average. They hesitate. They see rotation. They enter anyway. Then the box pulls price back. That is not execution. That is impatience. May 5th U.S. session stays inside its own box. The flow rotates. It does not set direction. The candle bodies cannot hold a clean side. The upper boundary gets tested. It fails. But price does not immediately collapse with clean follow-through. The lower side also does not give a clean breakdown early. So the short bias exists, but clean execution does not. That difference matters. Short can look better than long, but better direction is not enough. A trade still needs entry. A trade still needs stop. A trade still needs target. If one of those is unclear, the trade is weak. Here, the official decision is no trade. The better account decision is no trade. Because May 5th U.S. session only rotates inside its own box. It does not give the clean failure sequence that we need. Now compare the bias. Price is above the 120 moving average. May 5th U.S. session forms high. The upper test fails several times. The basis candle has a long upper wick. That makes short more attractive than long. But the hourly flow does not fix location. It does not give a stable short entry. It does not give a clean stop that survives. It does not give a target that pays enough without forcing the trade. So we wait. No trade keeps you ready. You do not spend risk inside a box that cannot decide. You keep the account clean for the next line that actually matters. Now, there is an aggressive alternative. It is not recommended, but it can be studied. A very aggressive trader might carry a position from May 4th Asia session toward May 5th US session. That is different from forcing a new entry inside May 5th rotation. The aggressive structure uses May 4th Asia session memory. Long entry line. May 4th Asia session 150% area. Stop loss line. May 4th Asia session lower boundary. Take profit line. May 4th Asia session 200% area. Trailing target. May 4th Asia session 300% area. Risk-reward ratio 1.67. This setup is aggressive. Why? Because it depends on carrying the position through later session movement. It is not a clean, fresh entry from May 5th US session. It comes from earlier memory. The reason for the entry is May 4th Asia 150% area. In the earlier hourly flow, price could not even properly retest near May 4th Asia upper boundary. That shows stronger holding. So an aggressive trader may use May 4th Asia 150% as a long entry line. But this is weaker than the main setup. The ratio is only 1.67. The entry depends on memory from an earlier session. The trade has more layers. More layers create more failure points. One layer fails. The trade weakens. 2 layers fail. The trade is gone. That is why this is not the main plan. The safer plan is to avoid forcing May 5th US session. The stop sits at May 4th Asia session lower boundary. If price returns there, the carried long has lost too much control. The target sits at May 4th Asia 200% area. That is the first expansion target. If price holds and continues, the trail can extend toward May 4th Asia 300%. Risk-reward ratio 1.67. That number is not huge. So trade quality must be watched carefully. If the entry is late, the ratio weakens. If the stop is wide, the pressure grows. If the target is too close, the trade does not deserve risk. That is why this is aggressive. Not recommended as the main trade. Only a structure that can be studied. Now, if a trader does use partial profit with this aggressive carry, the same rule applies. The first profit must reduce pressure. If the first target stalls, protect more. A conservative trader can take 60% first and leave 40% for the trail. If price holds the first target and still builds distance, a trader can leave more for continuation. An aggressive trader can take 40% first and leave 60% for the trail. If the second push slows, do not wait for the clean top. A conservative trader can take 50% first, then 30%, then 20%. If pullbacks stay shallow and reactions stay slow, an aggressive trader can press more. An aggressive trader can take 20% first, then 30%, then 50%. But the percentages do not save a bad trade. They only manage a trade that already has structure. If the stop is not clean, do not enter. If the target does not pay, do not enter. If the session rotates without decision, do not force it. May 5th US session gives that exact warning. The top shows a wick. The candle hesitates. Short bias appears. But price rotates inside the box. A forced short can get trapped. A forced long has weak location, so the main answer is no trade. Only the aggressive carry plan exists as an alternative. Now connect the full day. The earlier setup gives clean execution. May 4th Asia compresses between May 3rd Asia 150% and 200%. It drops below lower boundary. It cannot stay weak. It turns. The long forms. It pays at 250%. It can trail to 300%. Then the next session changes the problem. May 5th US forms near May 4th US 400% area. The basis candle has a long upper wick. Price rotates inside the box. Short looks better than long. But the trade is not clean. Same method. Different answer. First, action. Then, restraint. The chart does not reward the trader who always enters. It rewards the trader who knows when the structure is worth trading. Price reaches. It reacts. It holds or fails. If it gives the line, you trade. If it only rotates, you wait. That is how the account survives, until the next clean session memory appears. Price pushes higher, but the entry is already behind it. The session forms near lower memory. May 5th Asia session forms near the lower boundary of May 5th US session box. It does not form far away. It overlaps near the lower side. It starts close to decision. That matters. When a session forms near the lower boundary of another session box, the market has to prove support. If price cannot hold there, the move breaks down. If price holds there and starts to move away, the long can begin before the breakout looks obvious. That is the key. Do not chase the candle after it runs. Find the place where sellers fail first. May 5th Asia session first stays inside its own session box. Price rotates there. It does not leave cleanly. Bodies stay small. Reactions come back. The box keeps holding price. Nothing is free yet. Then price starts to lift. It reaches May 5th Asia session upper boundary. It breaks above. That break matters. But the trade should not start there for a late trader. The better question comes earlier. Did price hold the midpoint? Did sellers fail to push through lower memory? Did price start to move away from the middle before the upper boundary broke? That is where execution begins. Now price continues. It breaks above May 5th US session upper boundary. The move now has strength. But strength is not entry. Strength is confirmation. The entry already needed to form lower. Then price pushes again. It reaches January 6th US session lower boundary. That area matters. It is not only a 1-hour level. It sits near December 2025 daily chart basis box lower boundary. It also sits near December 2025 weekly chart basis box lower boundary. It also sits near the 2026 monthly chart basis box lower boundary. So price is not just reaching another intraday target. It is reaching larger memory. A trader must feel that. The long can still work. But late buying there becomes dangerous. The move has already traveled. The next boundary is not ordinary. Now go back to the actual setup. Long entry line. May 5th Asia session midpoint. Stop loss line. May 4th Asia session upper boundary. Take profit line. May 5th Asia session 150% area. The entry sits at May 5th Asia session midpoint. Why there? Because price was still inside the box. The upper breakout had not fully opened yet. The midpoint becomes the first line, where sellers must keep pressure. If price holds below the midpoint, the long is weak. If price reclaims the midpoint and keeps moving away, buyers start building control. So the midpoint is not random. It is the first balance line inside the May 5th Asia session box. Price moves around it. Then it starts to hold above it. Distance begins to grow. Reaction becomes slower. The long begins before the crowd chases the upper break. The stop sits at May 4th Asia session upper boundary. That stop is under the active structure. It gives the long room to survive. If price falls back through that older upper boundary, the May 5th Asia long has lost too much control. The trade is no longer clean. That is where the position must be protected. There is another possible stop. May 5th Asia session minus 150% area. That can also be used. It gives more room. It can protect against deeper noise. But every stop must pass the same test. Can the target still pay? Can the trade still survive? Does the risk-reward still make sense? A deeper stop can be acceptable when the structure needs room. But if the stop becomes too deep and the reward cannot carry it, the answer becomes no trade. Risk must earn the right to exist. Here, May 4th Asia session upper boundary gives a clean structural stop. The take-profit line sits at May 5th Asia session 150% area. That is the first extension target after price leaves the box. If price reaches there and stalls, the trade has paid. If price holds and moves away, then the trail can begin. Price moves up. It breaks above May 5th Asia session upper boundary. It breaks above May 5th US session upper boundary. It reaches the first extension. The long pays. Now pressure changes. The easy part is over. The clean entry is behind you. Now the market moves into larger memory. Trailing target. January 6th US session lower boundary. Risk-reward ratio, 2.09. That trailing target matters because it lines up with higher timeframe memory. December 2025 daily lower memory. December 2025 weekly lower memory. 2026 monthly lower memory. When a 1-hour trade reaches that kind of area, you do not treat it like a simple breakout. You protect the profit. You watch the reaction. You do not assume the next candle will keep running. Price reaches. It tests. It must prove holding. If it cannot create distance, the trail has done its job. Now the stop must follow. A trailing target without a moving stop is just hope. The market has already paid, so the position must protect what it earned. But the stop cannot be too tight. If you pull it too close, normal reaction touches it. Then the trail hurts the trade. If you leave it too far behind, the trail protects nothing. The stop must follow structure, not fear, not greed, not excitement. If price holds above May 5th Asia 150% area and keeps building distance, a trail toward January 6th US lower boundary can continue. If price reaches that area and reacts back quickly, you protect the trade. Now partial profit can help. If price reaches the first target and starts to stall, protect more first. A conservative trader can take 60% first and leave 40% for the trail. If price holds the first target and distance keeps growing, a trader can leave more for continuation. An aggressive trader can take 40% first and leave 60% for the trail. Both approaches need the same rule. The remaining position must have a stop that makes sense. If the second push slows, do not wait for the perfect top. A conservative trader can take 50% first, then 30%, then 20%. If pullbacks stay shallow and reaction does not return fast, An aggressive trader can press harder. An aggressive trader can take 20% first, then 30%, then 50%. But the percentages do not save a weak trade. They only manage a trade that already has structure. If price cannot hold distance, protect more. If price keeps holding distance, let the rest work. Now the full May 5th Asia structure becomes clear. May 5th Asia session forms near May 5th US lower boundary. Price rotates inside the May 5th Asia box. It breaks above May 5th Asia upper boundary. It breaks above May 5th US upper boundary. It reaches January 6th US lower boundary. The long starts at May 5th Asia midpoint. The stop sits at May 4th Asia upper boundary. The first target sits at May 5th Asia 150%. The trail reaches January 6th US lower boundary. Risk-reward ratio 2.09. The trade works because lower memory holds. It works because price moves away before the upper breakout becomes obvious. It works because the target is not random. It works because larger memory is respected. The market gives the long. Then it reaches a bigger wall. That is where the next decision begins. Price reaches higher memory. But the short is not automatic. The session forms above recent structure. May 6th US session forms near the upper boundary of May 5th US session box. It also forms above May 5th Asia session upper boundary. So price is still high. It is not starting from lower memory. It is starting after the move already traveled. That matters. A high session can continue, but it must hold. If it cannot fix direction, the trade becomes dangerous. May 6th US session then rotates around the lower boundary of May 5th US session box. Price keeps moving around that lower side. It does not leave cleanly. It does not create stable distance. It rides the line. That is the problem. When price rides a boundary, traders feel action. But the market may still be undecided. It moves down. It reacts. It returns. It tries again. Distance stays unstable. Then price falls. It tests. May 6th US session minus 100% area. That looks bearish. But a test alone is not enough. A trader still needs a clean entry line, a stop line, a target line. Without that, the trade becomes emotional. Looking at May 6th US session, easy entry is difficult. Price keeps rotating around May 6th US session lower boundary. It cannot fix a clean side. The safer trader waits. No trade protects the account. That is the conservative answer. But there is a more aggressive view. May 6th US session forms above the 120 moving average. The basis candle is a bearish candle, with almost no wick. That matters. The candle opens. It pushes down. It leaves little hesitation. It shows selling pressure early. So probability can lean short, not because price is low, because the session opens high and fails to hold higher memory. But probability is still not entry. The hourly flow must support it. May 6th US session does not fully lock direction. It keeps rotating. It keeps testing. It keeps pulling traders into both sides. So a conservative trader should not force entry. Still, an aggressive trader can study the short setup. Short entry line. May 6th US session midpoint. Stop loss line. May 6th US session upper boundary. Take profit line. May 6th US session minus 200% area. Risk-reward ratio 2.95. The short entry sits at May 6th U.S. session midpoint. Why there? Because the session keeps working around its lower half. If price loses the midpoint and cannot reclaim it, sellers can press toward the lower extension. The midpoint becomes the decision line. Above it, the short is weak. Below it, pressure can build. But the entry needs discipline. Price must not simply touch the midpoint. It must fail to stay above it. It must move away. It must keep reaction small. If price crosses down and immediately returns, the short is not ready. The stop sits at May 6th U.S. session upper boundary. At first, that stop can look too shallow. It feels close. It feels easy to touch. But look at the behavior. If price comes back and tests May 6th U.S. upper boundary, the short idea has already changed. The move has retraced too far. The session has reclaimed the upper side. Direction has shifted. So the upper boundary is not just a tight stop. It is the line where the short loses control. If price reaches there, you leave. No debate. No hope. The target sits at May 6th U.S. session minus 200% area. That is the downside extension. If the midpoint fails and price keeps moving lower, that is where the short can aim. Risk-reward ratio, 2.95. The number looks good, but the setup is still aggressive, because May 6th U.S. session did not give a perfectly fixed direction. It rotated. It rode the lower boundary. It tested down. It reacted. So the trader must choose. Aggressive trader can execute only with strict stop discipline. Conservative trader waits for cleaner structure. Now there is another question. The yellow circle A, May 5th Asia session last hourly candle. The question is whether a short entry could form at May 5th Asia session 200% area. That question is valid, but it needs caution. The negative factor is timing. The candle appears right before the U.S. session begins. That is dangerous. Before a new U.S. session basis candle, the market can reset. A level that looks like rejection can become the origin of the next box. A short can be correct and still get trapped by session formation. So timing argues against entry. Now the positive factors. Price has moved far from the 120 moving average. Distance is stretched. The previous candle failed to continue higher. The test above did not hold. That supports short pressure. So the setup is mixed. Not clean. Not useless. Mixed. That means the answer depends on the trader. An aggressive trader might take it with smaller size and a strict stop. A conservative trader should wait. If aggressive entries have failed often, choose the conservative answer. That matters. A trader must know which mistakes repeat. If aggressive shorts keep getting trapped, do not call it opportunity. Call it a pattern. Then change behavior. The market does not reward the trader who always acts. It rewards the trader who knows which action fits the structure. Now return to May 6th U.S. session. Price forms high. The bearish basis candle gives pressure. The session rotates around the May 5th U.S. lower boundary. Price tests May 6th U.S. minus 100% area. The aggressive short setup can use May 6th U.S. midpoint as entry. The stop sits at May 6th U.S. upper boundary. The target sits at May 6th U.S. minus 200% area. Risk-reward ratio, 2.95. But the main lesson is not the short. The main lesson is selection. Not every bearish candle deserves a trade. Not every distance from the 120 moving average deserves a short. Not every failed test becomes execution. You need the session to give the line. You need price to fail there. You need distance to build after entry. If price only rotates, you wait. Now connect the day. The earlier session gives the clean long. May 5th Asia forms near May 5th US lower boundary. The midpoint holds. Price moves up. The long pays into larger memory. Then the next session becomes difficult. May 6th US forms high. The bearish candle warns. The lower boundary gets ridden. The minus 100% area gets tested. Short looks better than long. But conservative execution waits. Aggressive execution needs strict rules. Same method. Different answer. One setup gives long. The next setup gives caution. A possible short exists, but it must survive timing, rotation, and stop logic. Price reaches. It reacts. It holds or fails. If it gives the line, you execute. If it only rides the boundary, you protect the account. The next clean trade begins only when the session gives a cleaner decision. Price drops first, but the bounce cannot take control. The session forms at compressed lower memory. May 6th Asia session forms at the lower boundary of May 6th US session box. It also forms inside May 5th Asia session structure with about 50% compression. It does not form in open space. It forms under pressure. It overlaps. It compresses. It sits at the lower side of a previous decision area. That matters. When a session forms at the lower boundary of another session box, price has to prove recovery immediately. If buyers are strong, they reclaim the box. If buyers are weak, they fail near the upper side, and price returns lower. That is where the short begins. May 6th Asia session first moves down. It reaches May 5th Asia session lower boundary. It tests that lower memory. The move looks bearish. But the first drop alone does not give the full trade. Price still has to react. It still has to show where recovery fails. Then price moves back up. It reaches toward May 6th US session lower boundary. That level matters. It is not a random bounce. It is the lower boundary of the larger US box. If price reclaims it and starts holding above it, the short becomes dangerous. If price reaches it and cannot build distance, the short pressure stays alive. Price reaches. It reacts. It cannot take control. The bounce becomes weaker. Distance becomes shorter. Reaction comes faster. Now the short setup begins to form. Short entry line. May 6th, Asia session upper boundary. Stop loss line. May 6th, US session midpoint. Take profit line. May 6th Asia session negative 150% area. The entry sits at May 6th Asia session upper boundary. Why there? Because May 6th Asia session forms compressed under May 6th US memory. The upper boundary becomes the place where buyers must prove recovery. Price pushes into that upper side. It cannot keep control. It cannot reclaim enough distance. It stalls. That failure gives the short. You are not shorting because price is red. You are shorting because the recovery cannot hold at the upper side of the compressed box. That difference matters. A red candle can be late. A failed reclaim gives structure. The stop sits at May 6th US session midpoint. That stop is not random. If price reaches May 6th U.S. session midpoint. The short has lost the lower pressure. The market has reclaimed too much of the U.S. box. The failed recovery no longer controls the trade. So the midpoint becomes the damage line. If price gets there, you leave. No argument. No hope. No holding a bad short. The short only works while price stays under that memory. Now the target. Take profit line. May 6th Asia session negative 150% area. That is the first downside extension after the compressed Asia box fails. If price loses the lower side and cannot recover, the negative 150% area becomes the first target. Not because we want a big drop, because that is where the structure completes the first extension. Price moves down. It reaches the first downside extension. The trade pays. But the move does not have to stop there. If price keeps holding below broken memory, the trail can begin. First trailing target. May 6th Asia session negative 300% area. That area is important. It sits near the weekly 0.5 area. So the downside move is not moving through empty space. It is reaching higher timeframe pressure. That changes management. If price reaches the negative 300% area and reaction comes back fast, the trail has done its job. If price holds below it and distance keeps growing, the short can continue. But you cannot assume continuation there. Weekly 0.5 can slow the move. It can create reaction. It can shorten distance. It can pull price back. So you watch behavior. Price reaches. It reacts. It either keeps distance or it starts to return. Second trailing target. May 7th U.S. session negative 150% area. Risk-reward ratio 4.48. That second trail only matters if the next structure confirms continuation. You do not trail into the future because you want more. You trail only when price has already paid, and the next session keeps pressure. The stop must move with the target. A target that moves without a stop is only hope. The market already paid. Now the trade must protect earned distance. But the stop cannot be too tight. If you move it too close, normal reaction touches it. Then the original trade may pay more than the trailed trade. If you leave it too far behind, the trail protects nothing. So the stop must follow structure, not fear, not greed, not the last red candle. If price keeps lower highs and cannot reclaim May 6th Asia upper memory, the trail can remain active. If price returns into the box, the short is losing pressure. If price reclaims the May 6th U.S. midpoint, the short is damaged. Now, partial profit can help. If price reaches the first target and starts to slow, you protect more first. A conservative trader can take 60% first and leave 40% for the trail. If price keeps pressing down and pullbacks stay shallow, an aggressive trader can leave more open. An aggressive trader can take 40% first and leave 60% for continuation. The decision comes from behavior, not personality. If the second push slows, you do not wait for the perfect low. A conservative trader can take 50% first, then 30%, then 20%. If reaction stays weak and price keeps distance, an aggressive trader can press harder. An aggressive trader can take 20% first, then 30%, then 50%. But percentages do not save a weak trade. They only manage a trade that already has structure. The key is still the same. Price reaches. It reacts. It holds or fails. Now look at May 6th Asia again. The session forms at May 6th U.S. lower boundary. It compresses inside May 5th Asia memory. Price drops to May 5th Asia lower boundary. Then price bounces toward May 6th U.S. lower boundary. The bounce cannot take control. The short starts at May 6th Asia upper boundary. The stop sits at May 6th U.S. midpoint. The first target sits at May 6th Asia negative 150%. The first trail reaches May 6th Asia negative 300%, near weekly 0.5. The second trail reaches May 7th U.S. negative 150%. Risk-reward ratio 4.48. The trade does not come from chasing weakness. It comes from failed recovery. The upper side cannot hold. The midpoint stays above. Distance opens downward. That is the short. Price drops again. But every short still needs proof. The session forms below the prior box. May 7th U.S. session forms below May 6th Asia session box. Its range is about 200% of May 6th Asia session box. It also overlaps May 5th Asia session box. So the market is not quiet. It forms below prior memory. It expands. It overlaps older structure. It carries pressure from the previous short. That matters. When a new U.S. session forms below the prior Asia box, price is already under downside pressure. But pressure alone is not entry. The session still has to give a clean line. May 7th U.S. session then moves lower. It tests May 7th U.S. session lower boundary. It also moves between the lower boundary and the negative 150% area. This movement also tests the 120 moving average. That is important. The 120 moving average can slow the move. It can create reaction. It can trap late shorts. So you do not sell blindly after the first drop. You wait for the boundary. You wait for failure. You wait for price to show that it cannot reclaim. May 7th U.S. session gives the short setup. Short entry line. May 7th U.S. session lower boundary. Stop loss line. May 7th U.S. session midpoint. Take profit line. May 7th U.S. session negative 200% area. That target almost matches May 4th U.S. session upper boundary. Risk-reward ratio 2.05. The entry sits at May 7th U.S. session lower boundary. Why there? Because price is already trading below May 6th Asia session box. The lower boundary of May 7th U.S. session becomes the decision line. If price stays below it, sellers keep control. If price breaks back above it and holds inside the box, the short loses pressure. So the entry is not just a break. It is a failed recovery around the lower boundary. Price reaches the lower boundary. It moves below. It tries to return. If it cannot stay back above, the short becomes active. That is the condition. Touch is not enough. Break is not enough. Price must fail to reclaim. Then distance must open. The stop sits at May 7th U.S. session midpoint. That stop is important. Some traders may want a wider stop. Some may want the upper boundary. But the midpoint fits the behavior here. Why? Because this short uses the lower boundary as the entry line. If price recovers all the way back to the midpoint, the lower boundary failure has weakened. The short no longer controls the lower half. The market is no longer moving cleanly below the box. The short idea is damaged. So the midpoint becomes the stop. If price reaches there, you do not negotiate. You leave. The target sits at May 7th U.S. session negative 200% area. That level almost matches May 4th U.S. session upper boundary. That matters. A target should not be chosen because it looks far. It should connect to memory. May 4th U.S. upper boundary already acted as prior structure. When May 7th U.S. lower boundary fails, the negative 200% area lines up with that older memory. That makes the target cleaner. Price is not just falling into empty space. It is moving toward a known line. But there is pressure before the target. The 120 moving average is nearby. Price tests that moving average area during the lower movement. That can slow continuation. That can create bounce. That can make distance shorter. So the short needs management. If price breaks below May 7th U.S. lower boundary and immediately stalls near the 120 moving average, you do not assume extension. If it reacts fast and returns into the box, the short weakens. If it holds below the moving average area and keeps distance, the target can stay active. Now watch the behavior. Price moves lower. It reaches the lower boundary. It tests below. It pulls back. It tries to recover. The question stays simple. Can price reclaim the lower boundary? If it can reclaim and hold, the short is weak. If it cannot reclaim, the short remains valid. Then price moves toward the negative 150% area. The move is not perfectly clean. Reaction appears. The 120 moving average is being tested. That is where many traders make the mistake. They enter late. They see price dropping. They short after the move already stretched. Then the 120 reaction hits. Price bounces. The stop gets pressured. That is not structure. That is chase. The structured short begins at May 7th, U.S. lower boundary. Not after the extension already ran. Entry first, then target. Not target first, and entry late. Now the risk-reward. 2.05. That is usable, but it is not huge. So the execution must be clean. If entry is late, the ratio breaks. If stop is moved wider, the ratio weakens. If the 120 moving average blocks continuation, the trade becomes harder. That means the setup needs discipline. Price must lose the lower boundary. Price must fail to reclaim. Price must move away. The stop must stay at the midpoint. The target must stay connected to May 4th U.S. upper memory. If those conditions do not appear, the trade is skipped. Now think about trailing. If price reaches the first downside extension and starts to slow, you protect profit. You do not let a clean short turn into a full return. The target can extend only after price earns it. If price cannot hold below the lower boundary, no trail. If price reacts from the 120 moving average and returns fast, protect. If price breaks through and keeps distance, the short can continue. A trailing plan must reduce risk. It cannot add hope. Move the stop with the structure. If the stop is too tight, normal reaction removes the trade. If the stop is too loose, the trade gives back too much. So the trail must do one job: protect earned distance. Now connect this session to the previous one. The earlier short from May 6th Asia already showed the downside pressure. It paid through negative extensions. It reached near weekly 0.5. Then May 7th US formed below the prior Asia box. That continuation matters. But continuation still needs proof. May 7th US lower boundary becomes the next decision line. If it fails, short can continue. If it reclaims, the continuation is broken. That is the difference between structured continuation and emotional selling. Now, the full May 7th U.S. structure is clear. The session forms below May 6th Asia session box. It has about 200% of May 6th Asia volatility. It overlaps May 5th Asia session box. It tests lower boundary and negative 150% area. It interacts with the 120 moving average. The short entry sits at May 7th U.S. lower boundary. The stop sits at May 7th U.S. midpoint. The target sits at May 7th U.S. negative 200% area. That target almost matches May 4th U.S. upper boundary. Risk-reward ratio 2.05. The trade is not automatic. It needs the lower boundary to fail. It needs price to stay below. It needs distance after entry. The main lesson is simple. Bearish pressure can continue, but continuation still needs a line. May 6th, Asia gave the first short. May 7th, US gives the next test. If price keeps failing to reclaim, the short stays alive. If price reclaims the midpoint, the short loses control. Same method. New session. Price reaches. It reacts. It holds or fails. Then you execute. Price drops first. But the recovery cannot stay. The session forms under compressed memory. May 7th Asia session forms at the lower boundary of May 7th US session box. It forms with about 50% compression inside that May 7th US session box. It does not start from open space. It starts at the lower side. It starts inside pressure. It starts where the market must decide fast. That matters. When a session forms at the lower boundary of its own US memory, buyers have one job. They must reclaim. They must hold. They must build distance. If they cannot do that, the lower side stays heavy. May 7th Asia session first moves inside May 7th US session box. It does not leave cleanly. It rotates. Bodies stay smaller. Reactions come back. The box keeps pulling price back. Then price drops. It reaches May 4th US session lower boundary. It tests that lower memory. The move looks bearish. But the short is not created by chasing the first red move. A trader still needs the failure point. Price has to bounce. It has to test recovery. It has to fail there. Only then does the short become structured. Then price rises again. It reaches toward May 7th US session lower boundary. That level matters. If price can reclaim that lower boundary and stay above it, the short weakens. If it touches and cannot hold, the downside pressure remains. Price reaches. It reacts. It cannot build clean distance. The bounce stalls. Continuation fails earlier. Reaction gets faster. Now the prior short structure remains alive. Short entry line. May 6th Asia session upper boundary. Stop loss line. May 6th US session midpoint. Take profit line. May 6th Asia session negative 150% area. This is not a random short. This short comes from failed recovery. May 6th Asia session had already formed under pressure. Price had already failed to reclaim. May 7th Asia then continues that pressure by forming near the lower side again. The entry stays at May 6th Asia session upper boundary, because that was the upper side where recovery failed. If price cannot reclaim the upper boundary of the compressed Asia structure, sellers keep control. That is the entry logic. Not red candle, not emotion. Failed reclaim. The stop sits at May 6th U.S. session midpoint. That is the line where the short loses control. If price reaches that midpoint, it has reclaimed too much of the U.S. structure. The lower pressure is no longer clean. The short idea is damaged. So the stop stays there. Not too close. Not random. It sits where the idea breaks. If price reaches the midpoint, you leave. No hope. No argument. No waiting for one more candle. The target sits at May 6th Asia session negative 150% area. That is the first downside extension after the Asia structure fails. If price loses the lower side and cannot reclaim, that negative extension becomes the first place to take profit. The trade pays there, but the move keeps pressure. So trailing becomes possible. First trailing target, May 6th Asia session negative 300% area. That area matters. It sits near weekly 0.5. So the move is no longer just a 1-hour extension. It is reaching higher time frame pressure. When price reaches higher time frame pressure, you do not get greedy. You watch the reaction. You protect the short. You do not assume continuation. Price can slow there. Distance can shrink there. Pullbacks can deepen there. The market can take back profit fast. If price reaches that area and immediately reacts, the trail has already done its job. If price holds below and keeps distance, then the short can continue. Second trailing target, May 7th U.S. session negative 150% area. Risk-reward ratio, 4.48. That second trail only works after the market pays the first distance. You do not move the target because you want more. You move the target because price earned more. The target moves only after distance appears. The stop must also move. A trailing target without a moving stop is just hope with a better label. The market already paid. Now the trade must protect what it earned. But the stop cannot be too tight. If the stop sits directly behind the last candle, normal reaction can touch it. Then the trail damages the trade. If the stop stays too far behind, the trail protects nothing. So the stop follows structure. Not fear. Not greed. Not the last red candle. If price keeps failing to reclaim May 6th Asia upper memory, the short can stay active. If price returns into the box, the short weakens. If price reclaims May 6th U.S. session midpoint, the short is damaged. Now partial profit can help. If price reaches the first target and starts to slow, protect more first. A conservative trader can take 60% first and leave 40% for the trail. If price keeps pressing down and pullbacks stay shallow, an aggressive trader can leave more open. An aggressive trader can take 40% first and leave 60% for continuation. The choice comes from price behavior, not personality, not hope. If the second push slows, do not wait for the perfect low. A conservative trader can take 50% first, then 30%, then 20%. If reaction stays weak and price keeps distance, an aggressive trader can press harder. An aggressive trader can take 20% first, then 30%, then 50%. But percentages do not save a weak trade. They only manage a trade that already has structure. If price cannot keep distance, Protect more. If price keeps distance, let the rest work. Now watch the full sequence. May 7th Asia session forms at May 7th US session lower boundary. It compresses by about 50%. Price moves inside May 7th US session box. Then it drops to May 4th US session lower boundary. Then it rises toward May 7th US session lower boundary. That recovery fails. The short remains valid. The entry remains tied to May 6th Asia session upper boundary. The stop remains tied to May 6th US session midpoint. The first target sits at May 6th Asia negative 150%. The first trail reaches May 6th Asia negative 300%. Near weekly 0.5. The second trail reaches May 7th US negative 150%. Risk-reward ratio 4.48. The short does not come from selling late weakness. It comes from recovery failure. The bounce reaches. It cannot hold. It returns. That is the pressure. That is the execution. Price rotates again. But the final session removes the trade. The session forms inside the previous box. May 8th US session forms almost overlapping. May 7th Asia session box. It expands slightly, but it still stays close to the same structure. It does not open a fresh clean space. It forms inside memory. It forms inside rotation. It forms into the end of the week. That matters. A session can hold the midpoint. A candle can look stable. Price can rise. But if the session is the final trading window, and there are only a few hourly candles left, the trade changes. The clock becomes risk. May 8th US session continues inside its own session box. Price does not leave cleanly. It moves inside. It tests. It returns. Then price pushes higher. It reaches toward May 7th US session lower boundary. That level matters. It was broken memory. If price can reclaim it cleanly and stay above it, the downside pressure weakens. If price only tests it and cannot build distance, the market remains trapped. Now look at the May 8th US flow. It holds near the midpoint. That can look like a long. The midpoint holds. Price pushes up. The body moves away. A trader wants to buy. But this is where the trap begins. The session is still inside the box. The week is almost over. There are not enough candles left to give the trade room. If you enter from the midpoint, near the end of the week, you may not get time to manage. You may not get time to trail. You may not get time to escape. That is why the long is difficult. A midpoint hold is not enough. A final session midpoint hold is even weaker, because time is part of risk. If this were a larger time frame trade, the final session might matter less. A daily or weekly structure trader can hold through the calendar, but a 1-hour session trader must respect the clock. The method is built on session movement. The method needs time after entry. The method needs enough candles for target, reaction, and management. When the week is almost over, that space disappears. So the official decision is no trade. Not because price does nothing. Price does move. Not because the midpoint is meaningless. It matters. But the trade quality is weak. The session does not offer enough clean execution time. If a position was already open from the previous session, the decision is different. A trailing position can be held because the trade already earned distance. The risk is already reduced. The structure already paid. That is not the same as opening a fresh long at the end. A fresh entry adds new risk. A trailing hold manages old profit. Those are different actions. An aggressive trader may hold a prior trailing position. A conservative trader may still close, especially in the last session of the week. Because final sessions can trap. They can reverse without warning. They can stay inside a box. They can make the chart look alive, while the trade has no room. Now look at where price is rotating. This is not a random place. It is meaningful higher time frame memory. It is near February daily basis box upper boundary. It is near February weekly basis box upper boundary. It is near weekly 0.5. It is near the 2026 monthly basis box lower boundary. That is stacked pressure. Daily memory, weekly memory, monthly memory, all near the same zone. So the market is rotating at a serious location. That can create strong reaction. It can also create false confidence. A trader sees the midpoint hold. A trader sees price pushing up. A trader forgets the larger wall above. That is the danger. Higher time frame pressure can make 1-hour entries fail faster. Distance becomes shorter. Pullbacks deepen. Continuation fails earlier. That is why a new long is not clean. If price had broken above May 7th U.S. lower boundary and held with distance earlier in the session, the long could be studied. If price had more time and a clean target above, the trade could be considered. But here the session is late. The box is still holding. The higher time frame zone is close. The trade does not deserve risk. Now think about a short. Could a short form? Only if price fails at May 7th U.S. lower boundary and moves back below May 8th U.S. midpoint. But even then, the final session problem remains. The trade needs room. The trade needs time. The trade needs a target. If price only rotates, there is no clean execution. So the answer stays no trade. No forced long. No late short. No midpoint chase. No emotional end-of-week entry. The better action is to protect the account. If you already have profit, protect it. If you do not have position, wait. That is not weakness. That is execution. No trade keeps the method clean. No trade keeps capital ready. No trade keeps the next setup available. Now connect this to the earlier short. The previous structure gave a valid short. Recovery failed. The short paid. Trailing could extend. Then May 8th U.S. gives a different message. Price holds the midpoint, but the session is late. The trade is inside the box. The higher time frame memory is heavy. The final session reduces space. So the method changes. Earlier, execution. Now, restraint. That is real trading. You do not trade because a line holds. You trade when the line holds, with time, space, and target. Here, the line holds. But time is weak. Space is limited. Target is pressured. So the trade is skipped. The chart still matters. The rotation tells us something. It says price is sitting at an important decision area. It says next week may open with strong pressure. It says the next session memory will matter more. But today, inside the final session, the clean trade is not there. So the plan is simple. Mark May 8th U.S. box. Mark May 7th Asia overlap. Mark May 7th U.S. lower boundary. Mark the higher time frame cluster. Then wait for the next session. If price holds above the cluster and builds distance, the long can form later. If price fails there and returns below the box, the short can form later. If price keeps rotating, you wait again. The final session does not demand action. It demands discipline. Price reaches. It reacts. It holds or fails. But if the session cannot give time and space, the account stays protected. The 1-hour chart showed the pressure. Now the larger charts show why the pressure appeared there. Daily chart, weekly chart, monthly chart. This is where the week stops looking random. The 1-hour chart gives entries, but the bigger time frame shows the space. A 1-hour long can look perfect, but if the daily chart is already pressing into resistance, the target becomes smaller. A 1-hour short can look tempting, but if the weekly structure is still holding compression, the short needs failure first. A 1-hour no trade can feel passive, but if the monthly memory sits directly above, waiting can be the strongest decision. That is why we step back. Not to replace the session chart, not to predict next week. We step back to see where the session trades were moving. This week, price did not move in open space. It moved into stacked memory, daily memory, weekly memory, monthly memory. That is why the 1-hour chart kept showing the same behavior. Moves pushed, then stalled. Breakouts appeared, then needed proof. Shorts looked attractive, then required failed recovery. Midpoints held, but the clock removed the trade. The daily chart shows the active rotation. It shows where price traveled during the week. It shows the May 1st daily basis candle forming inside February daily memory. It shows the February daily upper boundary close to the May daily upper side. It shows the 120 moving average and the 0.5 area sitting near the same zone. That is not empty space. That is stacked pressure. The weekly chart adds the next layer. May 1st weekly basis candle forms between February 1st weekly upper memory and January 1st weekly lower memory. The move has already left the falling trendline zone, but it has not escaped all weekly memory. That creates the trap. A breakout can look strong, but it still needs to stay outside the old pressure. The monthly chart adds the largest frame. May is testing the 2026 first monthly box lower boundary. That area sits near the 0.5 zone. April already formed between 0.33 and 0.5. April checked the March upper wick. April overlapped the February drop. So recovery is real, but recovery is still testing. It is not free yet. Now, next week becomes clearer. If price holds above the daily and monthly cluster, continuation can form. If price reaches that cluster and cannot stay, failed breakout shorts can form. If price rotates inside the same higher timeframe memory, targets must stay tighter. If the next Asia or US session forms inside that memory, entry needs more proof. That is the purpose of the higher timeframe section. The 1-hour chart tells us where to act. The daily chart tells us how much space remains. The weekly chart tells us where pressure waits. The monthly chart tells us whether recovery has truly earned freedom. Now we read the daily chart first. Price pushes higher, but late entry loses space. The daily structure forms inside February memory. May 1st daily basis candle forms inside the February 1st daily basis candle box. It is only slightly compressed. It overlaps almost directly. The important point is the upper side. May 1st daily basis candle upper boundary almost matches February 1st daily basis candle upper boundary. That matters. Price is not starting below all resistance. It is already forming near the top of February daily memory. The move can break higher, but the space is not wide. The upper pressure is already close. That is why the 1-hour chart kept punishing late entries. A 1-hour long could work from lower memory, but a late chase near the upper side had less room. Now price moves up. It breaks above the February 1st daily basis candle upper boundary. That break matters, but it does not give full freedom, because the next memory is close. Price rises toward the January 1st daily basis candle lower boundary. It is trying to test that area. That becomes the next daily objective. Now look at the cluster. February 1st daily upper boundary. Weekly 0.5 area. 120 simple moving average. They sit close together. This is not a simple breakout zone. This is a decision zone. Price reaches there. It must hold. It must build distance. It must not return quickly back inside February daily memory. If it cannot stay there, the breakout weakens. If it holds there, the next long structure can form. That is why next week cannot begin with blind chasing. The daily chart is already warning us. The 1-hour chart can show green candles. But the daily chart shows the wall. A trader who enters early from session memory has space. A trader who enters late near the daily cluster has pressure. The stop becomes awkward. The target becomes short. The reaction becomes faster. That is how late trades fail. Now read the May daily structure again. May 1st daily basis candle forms inside February 1st daily basis candle box. It slightly compresses. It overlaps. The upper boundary almost matches February upper boundary. Then price breaks above February daily upper memory. It tries to reach January daily lower memory. That means the week's rally is not random. It is a move from February daily memory toward January daily memory. The 1-hour chart showed that as session breakouts. But the daily chart shows the larger path. From February box toward January lower boundary, into 120 moving average pressure, into 0.5 pressure. That is the map. Now the strategy. If price holds above the February daily upper boundary, 1-hour pullbacks can become long setups. But they must hold. They must create distance. They must not fall back quickly into the February box. If price breaks above and returns back below February daily upper boundary, that becomes failed breakout behavior. Then shorts can form on the 1-hour chart. But not before failure. Shorting just because price reached resistance is not enough. Price must fail to stay. If price keeps rotating between February daily upper memory and January daily lower memory, range behavior stays more likely. Targets must stay realistic. Trailing needs proof. No trade becomes valid when the 1-hour chart forms inside the cluster without a clean edge. Now look at the 120 simple moving average. It does not create a trade by itself, but it changes the quality of the trade. When the 120 simple moving average sits near the February daily upper boundary and the weekly 0.5 area, price must prove acceptance. A small break is not enough. One candle is not enough. A wick is not enough. Price must stay above. It must move away. It must make pullbacks shallow. If reaction comes faster and distance becomes shorter, the move is weakening. That is the daily filter. The daily chart makes this week easier to understand. Why did some long trades work early? Because price was moving from lower session memory toward the daily cluster. Why did late entries become risky? Because price reached the upper side of the daily structure. Why did no trade decisions matter? Because movement inside a higher timeframe cluster can look active, but still lack space. The daily message is clear. May is testing the top side of February daily memory. The next test is January daily lower memory. But the 120 simple moving average and the 0.5 area stand near the path. So next week needs patience. If price holds above the cluster, long continuation can build. If price fails there, short setups can appear. If price rotates inside the cluster, no trade can protect the account. The daily chart gives the space. The 1-hour chart gives the trigger. Price reaches. It reacts. It holds or fails. Then you execute. Price breaks out from trendline pressure. But the weekly structure still traps the move. The weekly candle forms between old memories. May 1st weekly basis candle forms between February 1st weekly basis candle upper boundary and January 1st weekly basis candle lower boundary. It is compressed there. It does not form an open space. It forms between the lower ceiling from January and the upper side of February memory. That matters. The move can look strong, but it still sits under larger weekly pressure. Now look at the sequence. March 1st weekly basis candle forms inside February 1st weekly basis candle box. April 1st weekly basis candle forms inside March 1st weekly basis candle box. May 1st weekly basis candle forms near the upper side of February 1st weekly memory. Since March, the weekly basis candles keep compressing. The structure keeps narrowing. Pressure keeps building. The market is not giving full freedom yet. It is forcing decision. This is why 1-hour moves have been sharp. Compression creates movement. But compression also creates traps. Price can break, then return. Price can extend, then fail. Price can look free, then hit older memory. The weekly chart explains that behavior. Now look at the falling trend lines. From February, price moved between the first falling trend line and the second falling trend line. It moved sideways there. Then it broke upward. That upward break matters. But the break alone is not enough. Price must stay outside that pressure. It must build distance. It must not return back into the same trendline zone. If it returns, the breakout weakens. If it holds, the next continuation can form. So the weekly chart gives two messages at the same time. The first message is strength. Price has moved out from the falling trendline area. The second message is caution. Price is still trading between weekly memories. That is why the weekly chart does not say chase. It says test. Now look at January. February, March, and April basis structures formed below the January 1st weekly box. That January lower boundary remains important. If price pushes into that area, reaction can appear. If price breaks and holds above it, the weekly structure opens more space. If price fails below it, the weekly breakout can rotate again. The 120 moving average also sits above the current area. That can create another rotation. So even if price breaks above the current weekly compression, the next upper pressure is still there. This matters for execution. A trader cannot look at the weekly chart and say only long. A trader cannot look at resistance and say only short. The real question is simpler. Where can price stay? If price holds above the compressed weekly structure, pullbacks can become long setups. If price reaches the January lower memory and fails, shorts can form after failure. If price keeps rotating between February upper memory and January lower memory, targets must stay closer. Breakout chasing becomes weaker. Boundary trading becomes stronger. Now connect this to the daily chart. The daily chart shows price near February daily upper memory 0.5 and the 120 simple moving average. The weekly chart shows price between February weekly upper memory and January weekly lower memory. Both charts say the same thing. The move is strong, but the move is not fully free. That is why next week needs session confirmation. If Asia forms above the weekly cluster and holds, long continuation can build. If US forms near the upper memory and fails, short pressure can appear. If both sessions compress inside the same weekly zone, no trade can be the best decision. The weekly chart controls the environment. The 1-hour chart still controls entry. Do not trade the weekly chart alone. Use it to decide whether the 1-hour setup has room. If price is near weekly upper memory, take profit faster. If price pulls back into weekly support and holds, look for session-long entries. If price fails to reclaim the weekly upper side, watch for short continuation. If price is stuck between the boxes, avoid midpoint traps. Now the strategy becomes clear. For next week, the breakout must hold. Price must stay outside the falling trendline pressure. Price must build distance above May weekly memory. Price must deal with January lower boundary and the 120 moving average. If it cannot, continuation fails earlier. If pullbacks deepen and reactions come faster, the move is weakening. If distance stays clean and price holds above broken memory, the long remains alive. The weekly chart gives pressure, not prediction. It tells us where price must prove itself. It tells us where late entries become dangerous. It tells us why a clean 1-hour setup can still need tight target management. Now the full weekly structure is visible. May 1st weekly basis candle forms between February 1st weekly upper boundary and January 1st weekly lower boundary. March and April already compressed inside prior weekly boxes. Price broke out of the falling trendline zone. But it still sits under larger weekly memory. The move is real. The test is still active. Next week begins inside that test. Price reaches. It reacts. It holds or fails. Then the 1-hour chart gives the trade. Price looks like recovery. But the monthly chart still demands proof. May monthly candle is testing the 0.5 area. That area is the lower boundary of the 2026 first monthly basis box. It is not a small level. It is the largest memory on the chart right now. That matters. April monthly candle formed between 0.33 and 0.5. It checked the upper wick of the March monthly candle. It overlapped the falling part of the February monthly candle. That showed recovery pressure. Price moved back into the February decline. It did not stay buried under the drop. But recovery is not the same as freedom. Now May is testing the next decision. The 2026 first monthly basis box lower boundary. The 0.5 area. The same zone that lines up with larger pressure. If price can stay above this area, the recovery gains strength. If price touches it and cannot stay, the move can return again. So the monthly chart is not giving a simple bullish answer. It is giving a test. A large test. The 2026 first monthly basis box also formed overlapping the lower boundary of the 2025 first monthly basis box. That matters. Current price is not only testing 2026 memory, it is also interacting with the lower side of 2025 monthly memory. This is stacked monthly structure. The market is reaching a zone where older yearly memory and current yearly memory connect. That can create strong reaction. It can also create false confidence. A 1-hour candle can look strong there. A daily candle can push higher there. A weekly candle can break a trend line there. But the monthly chart still asks one question. Can price stay above the lower boundary? If it cannot, the recovery weakens. If it can, the next larger continuation can form. Now connect this to the week. The 1-hour chart showed price pushing higher into memory. The daily chart showed May forming inside February daily memory and testing the upper side. The weekly chart showed price breaking out from falling trendline pressure but still trading between weekly boxes. The monthly chart shows the same move testing the 2026 monthly lower boundary. All three larger timeframes point to the same problem. The move is strong, but it is still testing. That is why late longs are dangerous. That is why shorts need failed holding. That is why no trade can be correct inside compression. The market is not giving full freedom yet. It is asking for acceptance. Acceptance means price stays. Price holds. Price builds distance. Price does not return immediately. Without that, every breakout remains a test. Now plan next week from the monthly chart. If price holds above the 2026 monthly lower boundary and does not return fast, 1-hour pullbacks can become long setups. But they need session structure. Asia must form. US must form. Price must hold a boundary. The stop must sit where the long actually fails. The target must connect to the next memory. If price reaches above the monthly lower boundary and then falls back below it, failed breakout shorts can form. But again, not blindly. You need failed holding. You need a reclaim failure. You need distance after entry. If price compresses around the 0.5 area, do not force entries. The monthly zone can trap both sides. It can make one-hour moves look strong and then reverse. It can make small breakouts fail faster. It can shrink target space. So the plan stays strict. No chase into monthly memory. No short without failed holding. No long without acceptance. No trade inside unclear compression. Now look at April again. April formed between 0.33 and 0.5. It confirmed that price was no longer only collapsing. It moved back into the February drop. It checked the March upper wick. That recovery is important. But May must continue the work. May must prove that price can hold at the 2026 monthly lower boundary. If May cannot stay above that zone, April recovery becomes only a test. If May holds above it, the market can build the next leg. That is why the monthly chart matters. It does not give the entry. It gives the battlefield. The one-hour chart gives the trigger. The monthly chart tells us whether the trigger has space. So next week, mark the monthly lower boundary. Mark the daily February upper memory. Mark the weekly January lower memory. Mark the 120 moving average zones. Then wait for the next session boxes. If price forms above the monthly zone and holds, look for long continuation. If price forms above and fails, watch for short pressure. If price forms inside the zone and rotates, protect the account. The week is complete now. The one-hour chart showed action. The daily chart showed limited space. The weekly chart showed breakout under pressure. The monthly chart showed recovery still testing the 2026 lower boundary. No prediction. Only preparation. Next week begins at a serious level. Price reaches. It reacts. It holds or fails. That answer creates the trade.